If you've seen our past videos, you'll know that we're big fans of trend following at Ironclad. But what we haven't touched on yet is just how these trend portfolios come together to begin with. And so we thought we'd make a series of videos answering that very question. Because we replicate some of the biggest trend followers in the business, we have to have insight into what they do behind the scenes. And so in this first video, we'll start all the way in the beginning and walk you through how we think about whether there is edge in the strategy to begin with. Just before we begin, a quick recap on the strategy. Trend following is one of the world's most popular hedge fund strategies and maybe one of the easier ones to understand as well. The strategy goes long rising markets and it goes short falling markets, and it profits from a continuation in those trends. We like it for three really simple reasons. First, it's delivered equity-like returns over decades. Second, some of trend's best performances have coincided with some of the worst for equity, making it a really powerful diversifier. And finally, and perhaps best of all, trend can be overlaid really efficiently on top of equity, which means that you don't have to give up any equity exposure in order to get trend. You can have both, and that's a big part of what we do for our clients here at Ironclad. Now that you've got some background on the strategy, let's get into how we think about testing for trend effects. One nifty approach is to use a regression. Fair warning, there will be some statistics in this video, but please don't click away. We're only going to focus on the key takeaways that they give us. We start by plotting some historical monthly returns versus subsequent returns of a given asset. Let's say that we wanted to test whether the return from 12 months ago had any bearing on this month's return. We'd draw up a scatter plot with each dot showing prior 12-month return on the x-axis and each's subsequent month return on the y-axis. Take this dot for example. It contains two useful bits of information. It represents the return on a given month, say October of last year, of 9%. And it also shows the return 12 months prior to October of last year of a similar number. By plotting enough of these dots, we can study the relationship between the two variables. Now, if there were no relationship between the variables, it would look something like this. And if we were to fit an ordinary least squares regression to the data, it would only confirm that the data is totally random. Knowledge of past returns has no explanatory power using this lookback, and this is not a reliable indicator. On the other hand, a super strong relationship between variables looks something like this. When lagged returns were very negative, subsequent returns tended to be so as well. When lagged returns were very positive, future returns tended to be so as well. This looks like a much more reliable indicator. Now let's have a look at a real-world example. Let's study monthly excess returns on the S&P 500 by having a look at E-mini returns from January 2000 to May 2024. Let's see whether lagged returns, in this case 12-month lagged returns, had any explanatory power on subsequent returns. As you might expect, real life is messy. Dots are all over the place. But if you were to fit a regression, we'd see a noisy but positive relationship. That might not have been obvious to the naked eye, but remember, in investments, you don't have to be right 100% of the time to make money. By way of example, Roger Federer, in a recent commencement address, made mention to the fact that although he won almost 80% of the matches in his career, he only did so by winning 54% of the points he ever played. By pure coincidence, when we looked at daily returns on the S&P 500 over the period we investigated, daily returns were positive barely over 54% of the time. But despite this, the S&P was up 470% cumulative over the period. And that's very much the nature of the business. If edges were easy to find and easy to exploit, they'd be gobbled up before breakfast. They wouldn't exist. My point being, small advantages can still compound very well over time. So we've looked at a single lag on the S&P and we've assessed that there might be something there. But what if we were to run more regressions? Here I show the outcome of 6 different lagged returns versus subsequent returns. I'm sure you'll agree that it quickly becomes too much information to process with the naked eye, especially considering that if we want to run a robust study, we want to investigate more lags than just 6 and on many more assets than just the S&P. So instead of eyeballing dozens upon dozens of regressions, we summarize all the information embedded in our regressions into a single and powerful metric, the t-statistic. I'll leave some background material in the description box below for those seeking a more technical understanding, but for the purposes of this video, we'll simplify and say that it tells us 2 useful bits of information. A positive t-stat suggested a positive relationship between the variables. So if lagged returns were greater than 0, subsequent returns tended to be so as well. The second bit of useful information about the t-stat is its absolute size. The bigger, the more robust we think the relationship tends to be, and the less likely it's just a statistical aberration. Now let's move away from having a million dots on the screen to a slightly neater format. Here we see the T-stats on monthly S&P 500 futures returns at lags from 1 month to 14 months. Remember, a positive T-stat implies some trend effects. The size of the bars can also guide our thinking in terms of how robust we think that relationship seems to be. In this case, we see that short-term lags actually seem to show some signs of reversals. Longer-term lags, however, show a positive pattern on average, which is a sign of trend effects. We want to steer clear from cherry-picking any single bar. Analysis of this kind gives us specific answers, but what we're really looking for are broader truths. As interesting as these results are, we'd very rarely settle for just trading a single market if we had the choice to diversify with more. So let's look at equity as an asset class, proxied by 14 different global equity markets. We could of course do this individually and study the T-stats for each and every one of the global equity markets for each and every lag, or we could do one better and simply look at them in combination. To observe the results in combination, we use a pooled panel regression. The details aren't important, but the takeaways are. It allows us to get a better feeling of where the trends are more present when we diversify. The below appears to be a lot better behaved than the S&P 500 did in isolation. While still noisy, we see some positive evidence of trend in the data, at least up to lag 10. Right, so that's equity, and we're starting to see some trend effects, particularly over longer lags. But in the same way as we wouldn't want to settle for a single market in the S&P 500, why should we settle for a single asset class when we don't have to? So let's bring in 3 other asset classes globally diversified into the mix as well, namely commodities, government bonds, and currencies. Some clarity begins to emerge when we view the T-stats at different lags for all 4 asset classes separately. I know there are many bars to look at, but rather focus your eyes on the red lines which depict the average T statistics at different lags. Assets have historically tended to exhibit trend in general, especially over lags shorter than 12 months. Returns have tended to actually reverse at and after the 12-month mark, which is very much in line with published research. So what if we were to put all of this together in a single portfolio view in the same way as a proper trend follower would actually look at things? To do this, we stack all these asset returns together in a single pooled panel regression, and we begin to see even more persuasive evidence of trend effects. For all lags up to the 11-month mark, except for one, we see a positive relationship between lagged and subsequent returns. Additionally, at and after the 1-year mark, we start seeing the same evidence of returns reversing, which again is very much in line with past research. In conclusion, this video kicks off a series of videos in how trend following portfolios get made. We start right at the beginning with how we think about testing for edge in the strategy, which is to say, how do we know that there is a trend to follow in the first place? To do this, we study monthly excess returns on 62 different global markets, encompassing global equities, government bonds, currencies, and commodities. We find solid evidence for trend effects up to about the 11-month mark, after which returns actually tend to reverse, which is very much in line with past research. In short, markets that have been rising tend to continue rising, and markets that have been falling tend to continue falling. Look out for our next few videos where we'll demonstrate how trend following portfolios can be built to take advantage of this finding. If you made it this far into the video, I'd like to thank you for your time. We'd be very interested in hearing your feedback or answering any questions that you might have about this strategy or any other. I'd like to invite you to follow the link to our website to get in touch. Thank you, and I'll see you in the next one.